Hi, it's Kat coming to you from LoanSense. I do want to talk a little bit about when should somebody consider a cash out refinance, especially in a higher interest rate environment. When I say higher interest rate, I mean we're in the sevens right now. We were 18 months to 2 years ago in like the high 2% interest rate. So, relative to what it was 18 months to 24 months ago, this is relatively high interest. So, I want to talk about when is it wise to consider a cash out refinance because I see trends of people's home equity growing and people are taking out cash out refinance like crazy. But again, the statistics are showing that mostly Black and Hispanic Americans are taking out cash out refinance. The reason I wanted to make this video is because when a trend shows that predominantly white Americans are the homeowners, yet Hispanic and Black Americans are the ones taking out cash out refinance, it makes me wonder what is happening in our financial lives that we will consider a cash out offer, including obviously people want to consolidate debts, right? People want to make much needed home repairs like replacing your roof. In Florida, we're in Florida, replacing roofs is really important. Replacing your AC system, really important because it's really hot here. But also making sure your home is hurricane ready and I don't want to say proof, but ready. And those upgrades can be fairly expensive, right? New windows, new roofs, new doors, new all types of things, and having the appropriate covers for the windows when a hurricane comes. So I understand that that can be very costly. And then, of course, people also take out a cash out offer to make investments that upgrades on their property that will make a return. For example, adding a mother-in-law suite that you can rent out. Here are some rule of thumbs I'd like to give on when a cash out refinance is financially smart versus, in my view, financially risky. Again, I'm not a financial advisor. I'm not a loan originator. I am just an individual who owns multiple homes and has an excellent credit score. Just speaking from my own personal experience is my point. This is how I think about it. If I were unwilling to finance a project, for example, if I were unwilling to say, I'm going to buy this thing or construct this thing and pay a 7% interest rate or higher, then I would not do a cash out refinance to pay for those expenses either. I think oftentimes, for example, like if I were to make a mother-in-law upgrade and I didn't want to take out a 10% loan to do a mother-in-law upgrade, then I'm not going to take out a 7% loan either, because that's essentially what it is, right? Or if that there's a 3% interest difference. But the point I'm trying to highlight is it's not free money. It's money that one is going to owe, and there's risk in it because if you can't pay this loan, then you lose your house, right? So there is risk, and I personally would never use a mortgage loan to pay off and consolidate higher interest debt. And the reason I wouldn't is because if I don't pay my credit card, I don't lose my home. I can tell the credit card company they can wait, or I can tell a debt collector, a medical bill collector, they can wait. But if I roll all that into my home and I can't make my house payment because my payment went up significantly because I rolled all my debt into it, then I can lose my home. So personally, I would not consider rolling in higher credit card payments unless it's an amount that I know I can reasonably pay off in the next year that wouldn't risk my financial and home security, the security of owning a home, in that credit card consolidation or that whatever loan consolidation that is. If I had a car with higher interest payments and I wanted to keep my car and roll it into my home because my car interest rate is higher than my home, let's just say that's the case, I could sell my car and buy a cheaper car, but I can't lose my home because where would I go, right? If I go rent, my rental price would probably be higher than my mortgage. So even with the cash out offer, like rental rates are really high. So just consider that. Yeah, another way to think about it is if you rented a place, how much would that payment be? And take the difference and just throw it towards the debt. That's what I would do instead of wrapping it in my house and then risking my home security. Okay. A second thing is for the mother-in-law suite. If I want a mother-in-law suite, which by the way, I speak about because I did, I made a mother-in-law suite as phase 1 of the project. Then phase 2 of the project is I turned the mother-in-law suite into a full 2-bedroom apartment. I did all of that based on savings and not based on a loan. So my first pro tip is there anything that you can save towards a long-term goal project month over month so that you don't have to take out any and pay any interest, but you can use some savings? If you believe it's going to take me too long to save and I can earn money on this 2-bedroom right away, if I took out $20,000 home equity, I can make the upgrades. And then I would make, let's say you can rent out the mother-in-law for $1,000 a month and you pay $20,000. What's a percentage? Like you need to generate at least $200 out of that $20,000 to justify 1% per month return. As long as you generate more than $200, if you put $100,000 in, you have to generate $1,000 a month. If you put in $20,000, you only have to generate $200 a month. So if you say, hey, I can take out $20,000, make the upgrades needed to rent out a mother-in-law, and you can rent it out for $1,000, that's an $800 plus to the minimum return you need to make. So in that case, it's worth doing a cash out refinance because you're going to get the money from the cash flow to pay the loan, right? I still personally saved just because I didn't want to take out a loan, and I was able to save pretty aggressively to make my mother-in-law upgrades. Also, I wasn't an emergency to make the upgrade because I was already renting it out for something, even though I could get more. So I wasn't like losing money or anything from the time that I didn't make the upgrade. I was just making a little less. So I hope my analysis makes sense, but essentially, if you bought a whole bunch of unnecessary items with your credit card, I think it could be harmful to use your financial asset that provides security to pay off the debt for those credit cards, for those unnecessary items, because you can tell the credit card company to wait, whereas you don't want the mortgage foreclosure process to start happening because one paid down a lot of credit card debt. And oftentimes lenders have a bunch of formulas on determining affordability that is outside of individuals' comfort. Like, for example, lenders might let me leverage up much more on my home purchase. When I was buying a home, the lender told me I could borrow up to, I don't know, it was $350,000 or something, or $400 even. But I was not comfortable with that size mortgage. I ended up buying, this was in Michigan, by the way, and it wasn't in this market. So I ended up buying a house for $120,000 because I rather have a lower living expense, lower lifestyle expense, and have that spread to live my life, pay for experiences, go on vacation, and not feel like I'm constantly trying to make a mortgage payment, right? So it's all about values as well. But again, pro tips are, what's the return? Does it return at least 1%? That, if so, that may make sense to take a home equity line of credit. If it pays for credit card or cars or things that are objects, that may not be the best use of trading in security, because interest rate spread is not the only risk, but there's a risk in losing your home. And how much of a risk is it? It totally depends on your personal situation, your budget. But again, I hope these pro tips helped. Consider, I would not just go with anything any loan officer says, because they might be able to give you leverage up to 50%, leverage up to 50% of your debt to income, which is give you up to 50% of your monthly take home expenses in debt, but that may not make you feel comfortable, number one. Number two is you may not want to use all your home equity right now. There are always things that come up in the future that you may need it for. And I just hope these pro tips are helpful. Everybody's financial situation is different, but just wanted to come in and chime in on here because, again, whenever there's a trend saying somebody is doing something that doesn't align, like for example, if Black and Hispanic Americans are doing something more and it doesn't align with the percentage of Black and Hispanic Americans that own homes, and it just makes me suspicious if cash out refinance offers are being targeted to specific borrowers who may be in a more financial precarious situation with inflation. So always want to give pro tips to anybody that this can help, and please like, subscribe, and share if you believe this is relevant. Just want to make sure everyone's getting accessible information and the right advice based on their scenario. Please ask questions. We are happy to answer them. Of course, we focus on student loan debt. So if you have student loan debt and you need help with that to fuel your down payment savings, fuel the payoff of that cash out offer you ended up taking, or doing anything to get in a financially better situation, please do not hesitate to get a free plan and get more information at myloansense.com, app.myloansense.com if you want a free student loan plan. Have a great day.